Hi, everyone, and welcome to the latest edition of our subject matter expert series, Economy and Geopolitics Key Insights for Distribution Leaders in 2026. I'll be your host today. My name's Ian Heller with Distribution Strategy Group. In just a few minutes, we'll bring in Alex Chalsovsky, who's the Director of Analytics and Consulting for Bundy Group. But before we do that, let's do just a little business. I want to tell you about our Distributor RX software suite. We've got three products that we've developed that are proprietary and exclusively for distributors. First is Customer Experience RX. This is a Net Promoter Score measurement system that will give you an MRI from your customer's perspective on your business rather than just a question and a comment like most NPS systems. This one asks questions about your sales rep performance, your customer service, your inventory position, your pricing. It asks all kinds of in-depth questions that you can then parse, slice, and dice by location, by customer type, say SIC code, by job function, et cetera. It's a true MRI in your business from the customer's perspective. And then we have an MRI from the employee's perspective. That's Employee Experience RX. This is built on the same architecture and gives you great insights on how you are functioning as an employer, which is really important in today's competitive hiring market. And then finally, Demand RX will help you estimate sales potential by product line, by account, or by prospect to uncover hidden opportunities to help you guide your sales reps' efforts. You can learn about all three at distributionstrategy.com/software. And we'd love to have a chance to demo these products for you. Now, I'd like to welcome in Jeremy Leduc with HawkSearch, and Jeremy is going to share a little bit about what HawkSearch can do for distributors. Jeremy, my friend, take it away.
Thanks, Ian. Can you guys see my screen?
Yeah, looks great.
Okay, great. Yeah, thanks so much. Happy to be here. Happy to be a sponsor. Real quick, HawkSearch. We've been in the B2B distribution and manufacturing space for quite some time as a search and product discovery solution. We have four main areas of our platform: the search, AI, merchandising, and analytics. Just very quickly, search, it's kind of funny. We've all been overlooking the fact that just basic search for a manufacturer and distributor is really important. Things like SKU search, partial part order number, or really complex stuff like, measurement conversion. That stuff's all still very real, very relevant in this space. And we do that really well. And in fact, Gartner rated us the #1 B2B search platform for those reasons. Now, we wouldn't be a relevant company, though, if we were not pushing the envelope with AI, and we are quite a bit. And AI has really helped us with stuff like this. I know this is a bit of an eye chart, but it's very relevant, right? You're looking at really complex searches, and that's what people expect today, right? They expect to put about basically anything they want into the search bar now with ChatGPT, and they expect a pretty relevant, pretty helpful answer back. And that's what we've been doing with AI is we're able to break down queries like this, queries that have the material in it, the product type, the compliance spec, the environment, and we're able to go out and say, okay, how are we going to get the most relevant answer from this? And sometimes it's just from our traditional search solution, and sometimes we're leveraging AI to pull that back. So we have three main buckets of AI now. We have AI-powered search. We have AI-powered answers, we call it. So we are now answering questions right from our search bar. We're also engaging in actual interactive conversations right from the search bar. And we have AI-powered assistants now. That's basically your agentic, your AI agents, where we're actually, we've got two right now. We've got an AI search assistant, so it's for the front-end website to help the customer, and we have a merchandising assistant to actually help your staff, the merchandiser on the back end, automate and increase productivity. So if you want to learn more, would love to chat. We've got a QR code, or just go to hawksearch.com.
Hey, Jeremy, before you go, we've done a lot of research around this, and what we've learned is that even distributors that don't do a lot of volume through their shopping cart still have an awful lot of shopping happening on their website.
Yeah.
People are just shopping on the website, then they're placing orders through other channels. So
Right.
having great search is important regardless of how much you actually sell online.
Yeah, great point. Yeah, good point.
Excellent. All right. Thank you, Jeremy. Really appreciate you sponsoring today's program. Good to see you again. And
Hey,
hey, distributors, go check out Hawk Search. You're not going to regret it. Awesome. So now let's welcome in the star of today's show, Mr. Alex Chalsofsky, a friend of Distribution Strategy Group, a friend of mine. Alex, as always, good to see you. I will encourage the crowd to jump in with questions early and often if you have them, because they're probably going to queue up pretty quickly. So welcome, Alex.
Thank you so much, Ian. Always a pleasure to be with DSG and all of the awesome distributors that you serve. Really appreciate the opportunity to talk to distribution leaders about what to expect from both the economy and the geopolitical world that we're living in 2026. I've got a lot to cover today. As always, I'll try to be very objective in my analysis and include practical and actionable things that they can do based on the observations around the economy, so you can actually put it into practice and not just good to know kind of category. We've got a lot to cover, as I mentioned. You've got, from the latest geopolitical events to new data coming out. We just had a labor report released this morning. I was able to incorporate that into the slides. So we're going to talk about things in a holistic manner. I'll break it down for you. I'll tell you what to expect. I'll give you the data-backed evidence of why I think that's going to happen. And again, leave you with some things that you can take away and share with your organizations and put to good use. But first, I want to establish a baseline. I want to tell you that despite sometimes feeling like the world is on fire around us, it's going to be okay. You're going to be able to get through 2026 just as you've gotten through other volatile periods before. Don't forget, you still have calluses on your brains from determining how to get through COVID. That was just a few years ago. And so I think that the key message that I want to deliver at the start of the presentation is we're clearly transitioning from an environment of uncertainty that was dominating in early 2025, before we knew what the tax climate was going to be like, before we knew what was going to happen with tariffs, to one that is now complete with complexity. And that complexity isn't going away. So what you need to do in terms of leading your people is to put on a confident face to say that no matter what is ahead of us, we're going to be able to get through it. I know that there's challenges. There's going to be things that we have to figure out. But together, we have the ability, we have the skill set, and we have the confidence to move forward into the future. And we're going to be okay. And we're going to be able to hit our goals as long as we execute on the plan. So I'm going to help you do that by going through a few different sections of the presentation. The first one is I want to give you a global perspective on what's happening. I think it's really important to have some context. We live in a very nuanced world. It's important to understand what's going on and how that's going to affect not only the US economy, but also your business more directly. We'll talk about the impact of some policy. I'm not going to go into too much detail on tariffs and taxes, but I do want to give you some perspective about what that's going to look like moving forward. We're going to review the latest economic data. I always go to data as being my main driver of decision making, so I'll share that with you. I'll not only inform, I'll also educate you. I'll show you how to use leading economic indicators to be able to see around the corner for not only the macroeconomy, but for your business specifically. And then, of course, at the end, I'll wrap it all up in a nice package for you with these key actionable takeaways that you could put into practice and get the kind of outcome that you want in 2026. So, as I said, lots to cover. We're going to get right into it by starting to zoom out. We're going to look at a satellite view of the global economy. And I tried to do this mainly to get a sense of what is the administration trying to accomplish through the various policy initiatives that it is pushing forward. So on the left-hand side of this slide, you have a snapshot of the global economy for 2025. On the right-hand side, what you're looking at is how the major players in the global economy have shifted or evolved their share of the economy over the last 45 years, going back to 1980. So let's start on the left. You can see that big blue square right in the middle, the USA, $30.3 trillion out of 115 trillion total global economy. We are by far the dominant force. We are the market share leader. We represent about 26% of global GDP, and that's not changing anytime soon. So this narrative that exists out there that we're somehow losing or falling behind or being overtaken by our adversaries just doesn't hold up to scrutiny when you look at the data. For instance, if you look up here, China even after multiple decades of double-digit growth, they're still less than $20 trillion in size, so about a third smaller than the US economy. And so when you talk about market share leadership, it is very clear when you look at the data that the United States still sits very firmly atop of the global economic pyramid. And I think that this is one of the things that the administration is trying to achieve, which is the preservation of that status of, us being the dominant economic player on the global stage. And that is a relatively novel approach. I think that other administrations, both Republican and Democratic, have not tried to think about things as a preservation of US economic supremacy. But President Trump, whether you like him or dislike him, or you agree with his policies or disagree, it doesn't really matter what side of the aisle you're on. I think everyone tends to believe that he thinks about the economy and managing the US government as a business. And so if you are the global market share leader in an industry or in a specific market, you're going to look to leverage that position to gain some concessions from the people that you do business with. And that is one of the things that I believe President Trump has been trying to achieve through various policy initiatives. Now, again, I don't always agree with the way that he's going about it, but it does help me make sense of the world a little bit by knowing that that is at the top of his agenda. He's trying to preserve our status as the #1 economy in the world. Now, if you look at the right-hand side of this slide, you can see that the fact that we've been able to stay on top of the pyramid for the better part of the last 50 years, but it goes even beyond that. Since World War II, really, the US has been the dominant economic force in the world. That's not the same as what other countries and other groups of countries around the world has experienced. So this white line here shows you that the share of the US economy as a percentage of global GDP started back in 1980 at around 25, 26%. And through various ups and downs, we are right back there where we started at 26.3% as of 2024. Now, I'm also very encouraged that after hitting a relatively low point in our market share back during the 2008-2009 Great Recession, we have actually been regaining share for the better part of about 15 years now. That's a positive development over the last decade and a half, and I hope one that continues as we look out towards the future. The same thing cannot be said about many of our traditional economic and military allies. So if you look at the blue line, for instance, that's the EU. The EU started back in 1980, combined with almost 30% of the global economy. And over time, you can see, as of 2024, it is now down to 17%. So that's almost a cutting in half of its market share over the last 45 years. The next line down, pink, that's Japan. You can see Japan peaked at around 18% of global GDP in the mid-1990s, the heyday of Japanese technological supremacy with Sony, Philips, Panasonic, all of the big Japanese players really dominating the global markets. But since that peak, they have lost a whole lot of share. And today, I'm sad to say, it's unfortunate, but the Japanese economy is less than 4% of total global GDP. That's a remarkable story that we certainly in the United States don't want to follow that kind of trajectory. And of course, the losses on the part of both the Europeans and the Japanese have benefited no one more so than the Chinese, which is represented here by the red line. And you can really see, starting in early 2000, when China entered the World Trade Organization and has been subsidized by many of the other players on this chart in terms of growing its production capacity and becoming the cheap production source of world goods, they have really skyrocketed in their share. But interestingly to note that as of 2020, when the pandemic struck, they've actually had a bit of a share pullback because of the draconian closures that they implemented in response to COVID and the lack of rebound that they failed to see in terms of reopening the economy 2 years later in 2022. So it's a really interesting discourse on how the market share of the different important players in the global economy has moved over the last 45 years. And certainly, I believe that as President Trump considers this, he wants to make sure that the United States line stays above the rest and is not surpassed by anyone else. So I think a lot of the policy making is driven by that, not only preservation of supreme position, but also making sure that we're leveraging that weight, that heft that we have on the global stage to get not only concessions, but more favorable terms in all of the business transactions that we are engaged in as a country. Another really important geopolitical development has been in the form of the emerging power structure that has really changed, particularly in the last 5 to 10 years. So if you think historically, going back to the 1900s, there was really a bipolar world. There was the United States and there was the Soviet Union vying for global supremacy, both economically and militarily. But then in 1991, when the Soviet Union collapsed, we entered a brief period of unipolarity. That means that the United States was not challenged by anyone economically or militarily. In the last 20 years, that's evolved, but specifically, as I mentioned, in the last 5 to 10 years, we've had the emergence of a couple of new players in this power structure. One has been countries from the global south, and I call them the free agents. So it's countries like, for example, Turkey and India and Brazil. They don't always see eye to eye with the US or our democratically aligned allies. They also don't see eye to eye with the other pole, which is obviously the Chinese, the autocratic regimes like Russia and Iran and North Korea. And they vote with their feet. They basically align themselves based on the issue at hand, depending on what is the best outcome for them specifically. But the biggest development and the most recent one has been the emergence of the corporations, specifically US tech companies, as global geopolitical entities and players. If you look at some of the logos I've got here in the bottom right-hand corner, these companies are not only generating revenue at a country level scale. I mean, Google alone generates about $100 billion of revenue a quarter. That's really amazing. It exceeds most countries' annual revenues. But they're also using electricity and water at a country level scale to run their data centers and their AI infrastructure. And so increasingly, the leaders of these companies are now active in the geopolitical arena. Best example, obviously, being Elon Musk with the Doge initiative earlier this year. At some point in the spring of 2025, Elon Musk was actually negotiating with a foreign minister of Iran at the United Nations in order to curtail the progress in the Iranian nuclear program. More recently, a great example was Jason Wang, the the CEO of NVIDIA, traveling with President Trump on his Asia tour a few weeks ago to negotiate the sale of some of the most advanced semiconductors to countries like Japan and South Korea, and really being active in that geopolitical negotiating stage. But it goes even beyond that. These leaders are now supporting presidential campaigns. They're donating to, the midterm campaigns of several senators and House of Representatives members. And so they're very, very active, and they're starting to move the needle when it comes to global geopolitics. So when I talk about an environment where we're transitioning from uncertainty to complexity, this muddled picture, this more busy boxing ring, if you will, of entities, with the US and its allies firmly in one corner, in the opposite corner being China and its other autocratic allies like Russia and Iran, the emerging free agents of the global south, and these technology giants, the US corporate entities. It has become a very, very complex equation of how things happen. And so the reason that I want to share all of this with you is not only to say that, when the president is pursuing an agenda, he has to consider all of this in mind, but also as business leaders, you can no longer afford to create a single plan and then just focus on execution. In this complex environment, what you really need to be doing is wargaming this. So that means being prepared for a variety of different scenarios and knowing what levers you will pull and what actions you will take if scenario A happens versus scenario B versus scenario C. So I hope that gives you some context in terms of the global developments. I also want to give you a different perspective on the worldwide economy as well. So looking at GDP is fine, but there is this concept of purchasing power parity, or PPP, that also needs to be considered. PPP, simply put, alleges that different things cost very different prices all around the world. And a really good example of this is the Big Mac Index. Basically, it tracks the cost of a Big Mac sandwich from McDonald's in all the countries around the world. And I can tell you one thing very clearly, that a Big Mac costs a heck of a lot more in the US and in Europe than it does in China or in Southeast Asia or in Latin America. And so when you consider things from the point of PPP, what we see is that US is actually not the largest economy from that perspective. you can see here that China, in terms of PPP, is actually the largest. And nowhere is this more important than in the military and defense arena. So on the right here, you can see that, in terms of actual dollars spent, the US is by far the most freely spending country on this list. Almost $1 trillion of military and defense spending last year. Excuse me. If you look at China, they spent 314 billion, Russia 149 billion. But when you apply this concept of purchasing power parity to these amounts, you recognize that they are able to buy a lot more missiles and tanks and planes and ships and pay a lot more soldiers than we can with the same amount of dollars. So in PPP terms, the Chinese are spending somewhere on the range of $800 to $900 billion, and Russia is spending about $500 billion. And for this reason, we've actually been able to very clearly see the closing of the gap in military technology and the ability to project military power between the US and some of our biggest adversaries, namely China and Russia. So we're still the dominant military, bar none, because the ability to project power around the world is unrivaled for the US due to our aircraft carrier fleet. But the Chinese can now really effectively compete in the Indo-Pacific in terms of protecting their own interests in the region, being a little bit more belligerent, and yes, threatening to invade Taiwan. So this is another driving reason why I think President Trump is trying to throw some roadblocks and negotiate geopolitically with the Chinese when it comes to curtailing some of this advancement that they're doing in terms of the military arena and preserving U.S. military superiority, not only worldwide, but also in the region there as well. So basically, to summarize, I think we're trying to keep U.S. number one in terms of both the economy and in terms of the military. And that is what President Trump is trying to achieve through the agenda that he is pursuing. Of course, the biggest lever, the biggest tool in his toolkit has been tariffs. And I think it's very, very interesting to consider how differently he's pursuing tariffs this time around compared to his first term in office from 2017 to 2020. So the first difference is that back in his first term, he tried to get the backing of at least the Republican Party, his own party members in Congress, behind some of the Section 301 and Section 232 tariffs that he was trying to implement. This time around, he's acting unilaterally. He's not waiting for anyone's approval or asking anyone for permission. He's acting through executive order. And the things that he's pursuing through this tariff policy agenda are also quite evolved from what we saw happening I think 2017 to 2020. We're still talking about the trade deficit, which was the big focus back then. We're still trying to even out the balance between imports into the US versus exports into the US. But in each one of the negotiations, we're now talking about other things as well. Pardon me. For example, in the case of China, we have a discussion around national security interests. We have a discussion around critical minerals, and not only talking about rare earths here, we're talking about things like gallium and germanium. These are things that are used both in telecommunications equipment and semiconductor production, but also very much so in the military and defense space. And China, by the way, owns 97% of the gallium production of the world. And as a result, they've been showing their willingness to squeeze that production and not sell that very critical material, which also, as I mentioned, is used in military applications, to the United States at specific times. So this has been a big point of discussion between President Xi and President Trump when they're negotiating. In terms of our friendly, non-threatening neighbors to the north and south, Canada and Mexico, we're talking about things like immigration and the drug trade. And more importantly for distributor community is the issue of these Chinese transshipments, where China basically is skirting US sanctions and tariffs by first sending product into Canada or Mexico and then trucking it across the border into the United States. Now, I think it's really effective in some ways. We've seen Mexico, for example, address this issue of transshipments. We've seen Mexico for the first time implement their own tariffs on Chinese imports. So in several areas, President Trump is making some tangible progress here. But I think that it's important to not be binary when assessing the effectiveness of these tariffs. So in the case of Mexico, I support what President Trump is doing. In the case of Canada, it's much more difficult for me to lend my support there, because when I look at the trade that we have with Canada, I do agree that there is a trade deficit in place. However, this issue of immigration and drug trade doesn't have nearly the same weight or heft with the Canadians as it does with Mexico. In addition, when we look at the trade deficit we have with Canada, it's only because of our imports of oil and gas that that trade deficit exists. Outside of oil and gas, we actually run a trade surplus with the Canadian economy, which means that we sell more to them than they sell to us. And by the way, we don't want to stop importing Canadian oil because we get a significant discount to do so due to the infrastructure that is existing between our two countries in terms of the pipelines. We take that discounted oil, we refine it, and we sell the diesel, the gasoline, the jet fuel at a much higher profit margin to the rest of the world. So it's actually quite advantageous for us to do so with Canada rather than importing it from other countries. So the fact that we are currently running a 25% tariff on imports from Mexico, anything that is above and beyond USMCA, but a 35% import tariff on Canada, to me, that doesn't make any logical sense, and I would push back if I had the president's ear. Now, shifting gear to the last grouping here, Europe, Brazil, India, in each case, there's a specific point that we're trying to achieve, or President Trump is trying to achieve through his tariff negotiations. In the case of the Europeans, he's been very clear that he wants NATO to spend more on its own defense. I can fully support that. And we've actually seen traction in that area as well. Countries like Italy, Spain, Germany, Great Britain, they're all spending more on their own defense budgets as a result of these negotiations. In other cases, it's more difficult for me, once again, to kind of get on board with this approach. So let's take the issue of Brazil, for instance. There we implemented a 25% reciprocal tariff on Brazil because of the big trade deficit that exists. But then overnight, President Trump decided to double that without any kind of previous warning or heads up, from 25 to 50%, because he did not like the way that Brazil was prosecuting its previous president, Bolsonaro, for staging a coup in the last presidential election in Brazil. President Trump felt that there was a lot of similarity between the witch hunt, as he called it, between what happens with Bolsonaro and what he went through himself in response to January 6th. And so unilaterally, again, without any warning, doubled those tariffs overnight. To me, that does not hold up to scrutiny in terms of logic and reason. In terms of India, we're trying to dissuade Russian oil purchases. I can certainly get behind that, being from Ukraine originally, but still, the nature in which we're going about doing this, the overnight, no warning doubling, once again, of Indian tariffs from 25 to 50%, is very difficult for me to agree to, and very difficult for business leaders to adapt to in this hyper-fluid, constantly changing environment, sometimes seemingly connected to the whims of the president rather than logic or objective analysis that would justify such actions. But the biggest issue that I have with all of this that's been going on for the last 10 months is the unintended consequences. So first, China can certainly push back on cutting off supplies of rare earths. Rare earths are used in everything from permanent magnets to renewable energy products to telecommunications equipment to all basically the different things that we consume as Americans. They also have the ability to influence bad state actors like Russia, Iran, and North Korea. And they've shown their willingness to play that card. But the bigger issue is our traditional allies. We seem to be pushing them further away from us and closer to the waiting and welcoming arms of our main adversaries. Case in point, a great example of this was a recent summit in Beijing. President Xi was seen very, very friendly with Prime Minister Modi from India and President Putin. Now, Putin's obviously a long-standing ally, but historically, India and China have been fierce competitors, and we don't want to push India into the waiting arms of the Chinese. We want India to continue to align with the United States. And I believe some of the processes that we're following right now are actually putting that into jeopardy. So we just have to be very, very careful in terms of how far we push this thing. I don't want to spend too much time on tariffs other than to say there are currently three different categories of tariffs. There's IEEPA, which stands for International Emergency Economic Powers Act. That's basically all of the reciprocal tariffs and anything having to do with the drug trade, the opioid crisis, immigration. These are kind of emergencies that President Trump is saying are worthwhile in addressing via a tariff regime. We also have the Section 232 national security tariffs. These are very different beasts. These are enacted by Congress after a thorough review process of specific product categories. And if we determine that they're being unfairly or illegally dumped in the US market, we then move forward with tariffs against those product categories. And then certainly Section 301 is in the same vein, particularly targeting China. What we've had develop over the last couple of months is really interesting. For example, the appellate court has ruled that the IEEPA tariffs are unconstitutional. They've left them in place for now, but there are currently hearings going on at the Supreme Court that will determine whether or not these tariffs will be allowed to remain in place. Right now, it's actually looking like the court is going to strike down these IEEPA tariffs. That's the higher probability because the chief justices are all very skeptical in terms of the president's ability to call all of these different things emergencies that justify tariffs. Now, the administration has already started to pivot, right? We've already got a lot more focus on future Section 232 tariffs in place. In fact, there are currently over a dozen different product categories that are under investigation for future tariff enactment. That includes pharmaceuticals, semiconductors, refined critical materials, machinery and equipment, which will affect many, many distributors that are listening to this webinar. And so the administration is already starting to pivot. So the key takeaway for me in this, and the key takeaway for all of you from this should be that the tariffs aren't going away. They're going to evolve. They're going to continue through at least the rest of President Trump's second term, and who knows beyond that. So when I talk about this transition from uncertainty to complexity, I'm talking about in the beginning of the year, we didn't know what they would look like, and we were hoping that they would not stick around for long. Now, I think it's time to accept that they are going to remain in place in some capacity, and that we have to figure out how to work through them and around them rather than just blindly hoping that they're going to go away. So it is no longer acceptable to wait and see. You've got to develop a course of action and move forward with that. Now, the good news on the tariff side, and this is the last slide that I'm going to use to talk about them, is that basically the fear that we had at the beginning of the year that the tariffs were going to be extremely detrimental to the US economy, that has not come to pass. And the reason is that the effective tariff rate is very different than the actual tariff rate, what US companies are paying. So this blue line that you see on your screen right now shows the historic development of the effective tariff rate, starting with about 2% before President Trump took office for his second term. And through the various executive orders, the escalation, then de-escalation of rhetoric, we are currently at around an 18% effective tariff rate. That means if you take all of the tariffs in place, apply them to all the categories, we've got about an average of 18%. But what we've seen is that the way that US companies that are paying these tariffs have been dealing with this has made the actual tariff rate about half of that, or around 9%. So you can see here, the way that they've gone about this is they're taking different approaches. In some cases, for example, this dark blue slice, 9% of foreign exporters have shown that they will lower their selling price in order to preserve their US market share. That's what President Trump touted would happen. It is happening to some degree, but I think a much smaller percentage than the president would have liked to see. Some of the tariffs have already started to become passed to the US consumers, about 37%, but at least for now, the majority, or 51%, are being absorbed by US businesses. Now, as we look out to the future, we have to acknowledge two things. Number one, it is highly likely that this absorption will diminish over time, and more of these tariffs will be passed on to the end consumers. And number two, that that means that the inflation, the pressure on pricing, is likely to go up over time rather than down. And so the implication here is that although it's been fairly limited in affecting inflation up until this point, we have to look to the future and expect more upward pressure on prices as a result of this kind of funneling through of these tariffs to end customers, basically. So I think it's a very important thing for us to remember, that we're still in the early innings of this, basically, to say, on average, tariffs take somewhere between 9 and 18 months to fully make their way through the system. So, we've only been at this for a few months now. Most of that is likely coming in 2026. And as I mentioned earlier, there's still a lot of new tariffs likely to come in Section 232 variety. So those will still be affecting pricing moving forward. So as we look out in terms of inflation to 2026, my expectation is that we go up from here, not down. So we're getting further and further away from the Fed's 2% target. We're currently at 3% on both the overall consumer price index and the core CPI, which strips out the volatile food and energy prices. But I imagine that as this pass-through intensifies, we will likely see the inflation pressure ratchet up. My expectation is we remain in this 3 to 5% range, probably gravitating closer to 4% over the course of 2026. And I'm also leaving plenty of generous room to the upside for future tariffs that might skew this even higher. But I don't expect us to be in the 6-7% inflation environment, but certainly 4 to 5% is not out of the question based on the trajectory that we're currently on right now. Now, with that having been said, I think it's also important to contemplate the impact of the interest rate policy and the Fed's next actions. So this is the famous dot plot chart that the Federal Open Market Committee, or the body within the Fed that sets interest rate policy, puts out. You can see that they're telegraphing that they're going to do one more cut in December and then one more at some point in early 2026. But beyond that, we have kind of a plateauing of expectations to be seen here. And what that means is that we should not count on lower interest rates as kind of the magic bullet that's going to reinvigorate the industrial economy, the distribution sector in general. You have to understand that when it comes to interest rate policy, there are three strata or layers to that. Anytime the federal funds rate is at 4% or above, that's called restrictive interest rate policy. That means that the Fed is actively throttling or purposefully keeping a lid on spending in order to put downside pressure on inflation. That's basically where we've been for the past 2 years. Now we're transitioning to a period where we're going to be in neutral interest rate policy. That is between 3 and 4%. That's not viewed as either prohibitive or encouraging of economic activity. It's neutral in nature. In order for us to really get a boost, a tailwind from interest rates, we would have to be below 3% on the federal funds rate. And as you can see, the averages don't have us going there anytime soon. Certainly not in 26 and not in 27, 28 on average either. Now, that might change between now and then. This can be fickle at times, but at least as I view it right now, interest rates might come down a slight bit, 0.25, maybe 0.5% between now and next year, but certainly not significantly below that. So don't expect that to be the magic bullet that all of a sudden galvanizes the distribution sector and ratchets growth up in a significant manner. So getting away from tariffs, let's talk very briefly about the other catalyst that's policy-driven, and that's, of course, the One Big Beautiful Bill Act that President Trump signed into law back in July. Now, I will say that this has had a limited but positive impact on the economy in the short term. The primary drivers of that have been the domestic R&D expenditures that are now deductible going back 3 years, as well as the accelerated depreciation provision, which allows you to write off up to 100% of any CapEx type spending that you do as a business. There's many other provisions in this bill. In fact, it's one of the most complicated tax legislation pieces that we've ever had in the United States. There are over 80 instances where the bill isn't even finalized yet. It says the Commerce Secretary shall ... meaning that they're still going to work out the rules of those. So here's my key advice to you when it comes to the tax legislation. Get with a professional. It's okay to look outside of your organization for a subject matter expert. Understand all of the different provisions, whether it's qualified small business stock, or the increased Section 179 limits, the interest expense limitations. All of these things could be beneficial to your organization. They could offset some of the higher cost of doing business because of tariffs, but you really need to get with an expert to understand this. This information actually came from a company called Wipfli. I don't have a relationship with them, but I do know that they are experts in the space. So if you have further questions, I would recommend that you reach out to them or someone like them in order to really understand the ramifications of this new tax policy on your business more directly. All right. With the time that we have left, I just want to walk you through where the economy is, where it's not, and what likely you can expect moving forward. So the first thing that I'll say is, despite everything that I've just talked about, the US economy through midway in 2025 is bigger and more robust than it's ever been. We are literally at a record high in terms of our real GDP, which is already adjusted for inflation. However, looking below the surface at the vital signs of the economy, which is what I call the business cycle, that's growth rates plotted over time rather than the actual dollars associated with economic activity, we see a story that is slightly different. So this is quarter over quarter growth. So in this particular case, I'm showing you that Q2 2025 was up 2.1% compared to Q2 of 2024. That's the way that you look at the performance of your own business. So that's how I like to look at the economy as well. However, this is different than the information that you read about online. For some reason, when the government publishes GDP numbers, they do it sequentially. So they compare Q2 to Q1 or Q1 to Q4. To me, that doesn't make any sense because, we've got the holiday season in Q4, the lack of a holiday season in Q1. And so it doesn't make sense to me to compare those. But looking at it year over year, the way that a business looks at its own performance, that is sensible to me. And so I take heart in the fact that we are still up 2% year over year, and that is actually at the historic average of the last 20 years. So we're not seeing any evidence here that the economy is either in recession or is imminently heading for one. So to all of the doom and gloom people in your life, whether it's colleagues, family members, friends, show them this chart the next time they're talking about how the US is in recession and say, where do you see that happening? Or is it just like the fear and anxiety that's driving that perspective in you? Now, I will say that it's fair to mention that not all parts of the economy move in sync with one another. And so when we look at the different components, there are basically three. There's the personal consumption side. That's the money that you and I as individuals spend on living our daily lives. That accounts for about 70% of overall GDP. And in that particular bucket, what we see is a bifurcation, a split in the economy, and it becomes a little bit more K-shaped. So that means that most of the consumption that people are doing right now is happening because of the well-to-do, the top 20% of income earners, whereas the middle class and the bottom 40% of income earners are just keeping up with inflation. They're just spending money basically on pace with inflationary pressure. So this K-shape, this kind of splitting of prospects is indicative of the fact that there are winners and losers as a result of the current economic environment. There are markets and sectors that are outperforming, and there are ones that are underperforming as well. And it's important to pivot whenever possible to take advantage of the winning or the lower hanging fruit opportunities and mitigate the downside associated with potentially being exposed to the losing sectors or the sectors that are exhibiting the most weakness. Now, in terms of distribution, a much better benchmark for distribution is another slice of GDP that is basically CapEx. It's business to business. And for that, I use the Industrial Production Index. Now, you'll be able to tell right away that this series at face value is not what you saw in terms of GDP. This is not at a record high. It's gone through more ups and downs than GDP has. And in the last 2 years, we've basically seen very limited growth in the industrial economy, in manufacturing and construction. It's been a fairly weak period of time since early 2023. When we look at the vital signs or the growth rates or the business cycle of industrial production, what we see are some really interesting takeaways. So first, I'll point out that we actually had an industrial recession back in the 2016-2017 timeframe that was not evident in terms of GDP. GDP continued to rise at that time. What we see more recently as these lines, the dark blue line being longer term year over year growth, the light blue line being shorter term quarter over quarter growth, they've been kind of skirting that zero line. As I mentioned, since 2023, that shows that there's been very little growth in the industrial economy during this period of time. But what I was celebrating in late 24 and in early 2025 was that after President Trump got elected to his second term, we saw a real uptick in industrial production. That short-term growth rate, the light blue line, really started to accelerate into Q1 2025 until this peak happened. And the timing of this peak, and I think it's not a coincidence, was April or Liberation Day. At that point, the momentum basically crashed to a halt and the light blue line started gravitating more sideways rather than up. And right now, it's up 1% year over year. The annual trend is 0.7% year over year. So in positive territory, but very mild and weak single digits, low single digits growth in the industrial economy. The fact that that rising trend is faltering right now suggests that as we look out to the next 1 to 2 quarters, the most probable direction or movement of the industrial economy, of the B2B space, is sideways, not up and not down. So not into recession, not into that next leg of growth, but kind of treading water along this low single-digit positive growth profile. This shows the relationship between distribution or merchant wholesaler sales and industrial production. And basically, I wanted to show you this because I'm confident and convinced that industrial production is the benchmark for the distribution industry. You can see the green line here being distribution sales, the dark blue line being industrial production. And the difference, the delta that you're seeing there is because distribution sales are actually tracked in revenue and industrial production is an index. So it's more of an indicator of volume. So anytime that green line exceeds, especially on the upswings, the blue line, that's showing the impact of price increases, of inflation-driven revenue growth rather than volume-driven growth. And so what we're seeing with the latest data is distribution activity is up, roughly speaking, overall about 4% this year, but much of that is driven by price increases and not by actual growth in terms of the unit volume that's going on. And we can kind of dig in a little bit deeper into the details of this by looking at construction. So construction activity has also followed this K-shaped format that I showed you in consumption. Here we can see that all non-residential construction activity since the start of 2024 outside of data centers is down by over $55 billion. At the same time, data centers, and this really encompasses more AI infrastructure and semiconductor production, that is up $16 billion. So there are, once again, winners and losers that we can very clearly see in the industrial economy as well. So what I've showed you so far in the economic data front is called hard data. It's monthly, trackable, measurable. There are also soft data measurements that are driven more by a sentiment or the way that we feel, talk, and think about the economy. And a great example of this is the Conference Board's measure of CEO confidence that I'm showing you here. It's a really interesting narrative to look at the way that confidence rose off of the low point in 2022 through April of 2025. Again, Liberation Day, and then fell off a cliff in response to the reciprocal tariffs that we announced. It has bounced back somewhat in the third quarter, but only to this yellow dotted line, which represents kind of lukewarm or middle of the road type of optimism, meaning not super positive, not very negative. It basically kind of supports this assertion that I made with the industrial production data that the likeliest path forward is sideways rather than up or down. We're going to continue to move in this low single-digit growth profile for the foreseeable future based on CEO confidence. So the last thing that I want to cover with you before I hopefully have some time for Q&A on the back end is leading indicators. And very simply put, leading indicators are data series that accurately and consistently predict how other data series will behave in the future. So in this case, you're looking at two different data trends. The light blue line is the leading indicator. The dark blue is the underlying set of data that I'm trying to forecast. And I can see here that the peak in the indicator happens in 4Q of 09. The corresponding peak in the underlying data series is about a year later in 4Q of 2010. And this implies that there's a 12-month lead lag relationship between the light blue line and the dark blue line. And you can see consistently that the turns, both at the lows and the highs in the light blue line, always predict turns in the lows and the highs in the dark blue line. So once you establish that lead lag relationship, you can actually look at the last 12 months of data for the light blue line. And keep in mind, this is not a forecast. It's not a guess. This has already happened. You can physically manipulate it by pushing it forward by 12 months, aligning the two series, and then leveraging this light blue line to predict what the dark blue line is going to do. Now, this has some real profound implications, largely to say that what we should be focusing on is not what's happening in our business right now, but what is likely to happen in the future. Because imagine if you're here up 6% year over year, you've gone through this nice upward swing, you're likely going to want to be aggressive and invest in your business, hire people, buy new equipment, increase inventory. But the light blue line says a year from now, your growth is going to be zero, and you should not be doing any of those things. In fact, you should be tightening the belt, not committing to any long-term expenses, and watching, the bottom line more closely. So taking this methodology, let's look at the prospects for the industrial production segment and by relation for the wholesale distribution industry. So 3 leading indicators I'm going to share with you. The first one is total industry capacity utilization rate. This basically measures the percentage of current capacity in the industrial economy that we're using today to meet today's level of demand. This has already been shifted forward by 6 months because of its lead time, and you can see it's indicating sideways movement into 1Q of 2026. Another great leading indicator that I like to point to is copper futures prices. Why copper? Because it's used everywhere is the simple answer. In construction, in electronics, in automotive, in consumer packaged goods, copper is everywhere. And so this is volatile. You can see how kind of up and down that light blue line is moving, but the directional movement is very clear. It's sideways. So that means this is indicating that into mid-2026, that dark blue line for industrial production is likely to trend sideways rather than up or down. So no recession inside, once again, but also nothing to celebrate because there's not going to be nice positive growth as a tailwind to your business. And then the last indicator, the one that I like the most because it has the longest lead time, that's the ISM Purchasing Managers Index, or PMI. And once again, the messaging here is very consistent. It's very clear. It is moving in a volatile manner, up and down, but generally speaking, sideways, not up or down. Now, it's interesting because this rising trend was interrupted by, once again, April 2nd Liberation Day. It pulled back. And now we've been recovering since then, but there's not enough momentum there yet for me to feel confident in saying that we are going to enter the next leg upward in 2026. So as I read all of this, the implication to me and the implication to all of you as distribution decision makers and leaders should be, if I want something more than low single-digit positive growth, if I'm setting targets that are 4, 5, 6 or higher percent for 2026, I'm going to have to go out there and take it. I'm going to have to gain market share. I'm going to acquire new customers. I have to go out there and earn something more than low single-digit growth in 2026. Last couple of comments before we wrap it up here. In terms of the job market, we had the news come out this morning. September was actually surprisingly strong. We added about 120,000 jobs. The unemployment rate did tick up just slightly, but it got it to 4.4%. Average hourly earnings are still up 3.8% year over year. What that basically means is as you contemplate cost of living adjustments for your workers, COLA, you got to be somewhere in that 3 to 4% range just to be competitive with the rest of the market and to make sure that your people feel like they're not falling behind because inflation is also running at 3%. I do want to comment on the job gains this month relative to previous months because here we also see consistent messaging. In all of the months leading up into April, job gains were consistently up in the 100,000 plus per month range. Then the Liberation Day announcement happened, and you can see what happened in the subsequent 4 months after that. Basically fell off a cliff. To me, this is not the sign that there is an imminent recession looming. I always like to compare the job gains to what's happening in the layoffs. Layoffs tend to rise quite substantially as we're heading into periods of recession. So you can see here, in 2008, 2009, we saw this big surge of layoffs. Obviously, what happened in 2020 was completely unprecedented. I actually had to cut this line off. It's literally 5x the height if I were to plot it fully. But as I look to the latest data, what I'm seeing is layoff activity, despite the recent news alerts, is still relatively muted. Now, there are concentrations in the tech space, particularly with many of the technology companies implementing AI at a much faster pace than the rest of the economy and therefore shedding some workers. But there's nothing so far that makes me concerned that this is going to result in a recession as I see it. Okay, I know that was a lot of information. Thank you for bearing with me. Let me wrap it all up in a nice, concise package for you. As you think about the strategic implications of everything that I've said so far, there's three key elements I want you to focus on. Number one, allow data, not your emotions, to be the driver of your decision making. And that includes everything from tax impact, tariffs, what you see going on in your operations and sales. The second element is that if you want to grow above that low single digit baseline that I shared with you, you're going to have to go out there and win that business. Market share gains and new customer acquisition are key to 2026 growth. And then, as I said in the beginning, it's not enough to just have a single plan. You've got to be prepared for a variety of scenarios. You got to know what you will do in different outcomes, and you have to have those plans ready in advance. You can't wait to develop them when things happen, because then you're scrambling, you might make mistakes, and most importantly, you won't have that first mover advantage of if you already have the plan in place and can actively move forward with it. In terms of the more tactical things that I promised you at the beginning. So number one, ask yourself, what can I control in this environment? And you can control the amount of communication that you have, both up the supply chain and down to your customers. So if you're talking to your key suppliers once a quarter, make that conversation once a month. If you're talking to your top customers monthly, make that bi-weekly or even weekly. The more you have communication, the more you're willing to share insights about the state of the industry, what you're seeing out there, the more the party on the other side will be willing to do the same. And when you engage in that kind of discourse, that kind of open sharing, it elevates the relationship from a transactional one into a value-added partnership. And it builds a moat around the relationship, one that is not easily broken and one that will protect you. If there is a downturn in the future and they're looking to cut orders, for example, on the customer side, they'll look to do so with other people first and not with you. Another element in this inflation kind of up pressure scenario is protect your margins. Focus on margin preservation in 2026, and just revenue by itself is not enough. Remember, you're not in business to drive revenue. You're in business to make a profit. And so you got to be very cognizant of what's happening with your margins, not just at the overall level, but at the customer level and at the product level as well. And then the one way that I can see you contributing to the success is continue to invest in productivity and efficiency gains within the company. That, of course, means technology implementation and investment. And you don't have to go full bore. You just start to learn things, start to adapt things, and make it a process of continuous improvement over time. And if you're able to do all of these things, you'll be able to navigate the current both geopolitical and macroeconomic landscape just fine and achieve the targets that you're setting for yourself in 2026 and beyond. The last thing that I'll mention is this QR code is my LinkedIn profile. If you're not already connected with me, please do so. I'm always putting out commentary and objective analysis on what's going on in the economy, hopefully to help you make better decisions over time. So we'll make all these slides available. I'll send them to Ian. He can distribute them to everyone that's registered for the webinar. But with that, I'm 1 minute away from the top of the hour. I apologize for running a bit over, but I'm happy to stick around and answer any questions as long as it takes.
Yeah, we normally end at the top of the hour, and I know some people will have to go who are on the live audience. But if you're willing to stick around for a few minutes, I would like to continue the discussion.
I am willing to stick around.
Awesome. Okay, thanks. So I have the first question for you, which is that I saw that the spending on data centers is largely offsetting, or to some degree offsetting, what is otherwise a pretty steep decline in non-commercial construction spending.
That's right.
And then I heard yesterday on the Prof G Finance podcast that NVIDIA is 7% of the S&P 500. So it's it's like 3,500 times more than the average S&P 500 stock.
Right.
So that AI stock is overweighting the S&P 500, and generally speaking, AI stocks are sort of propping up the stock market. And there's
They
this
are. Yep.
increasing discussion about, well, is there a difference between how the stock market is performing and the underlying economy? But my question is, all of this is really about fear of there being an AI bubble. Do you have any insights or opinions on either whether or not that's true or what we should look for to see if one is developing?
Yeah. I think what I look for, and this was very evident in NVIDIA's post quarterly report earnings call yesterday, is expectations of what revenue growth will be like in the future. Now,
Yeah.
they guided to a fourth quarter revenue growth that is above consensus expectations, right? Revenue for NVIDIA is tangible, right? I mean, they reported something like $60 billion worth of revenue for Q3. That was a 65% growth rate. Now, they're obviously at the top of the pyramid. They are the
Right.
most benefiting from this. But I do think that if you look at the investment guidance from companies like Meta and Microsoft and Amazon and Google, in terms of what the next 3 to 5 years looks like, NVIDIA will continue to benefit from all of that because there is almost a limitless appetite for compute in terms
Mm.
of the data processing and the architecture involved there. They're continuing to develop new products. Jason Huang said that Blackwell sales are through the roof, above
Yeah.
expectations. They said several of their product categories are completely sold out right now. So I mean, I think that my concerns around the AI bubble is not that the investment will somehow all of a sudden evaporate, but rather that that seems to be quite a circular ecosystem developing in terms of NVIDIA is invested in OpenAI, who's investing in renting data centers from Oracle. Oracle is buying NVIDIA chips. So anytime you see that kind of circularity, you do need to be a bit wary about kind of, is this sustainable long term? But at least based on their latest report, which, as I said just yesterday, I'm not of the opinion that there is a bubble in terms of the overall thesis of investment into AI infrastructure. I just don't see that happening yet.
Okay. And another one, I don't know if this is within your area of expertise, so if it's not, just you can tell me. But I
Sure.
know there's a huge amount of debt being taken on by major corporations. Amazon's taken on a huge amount of debt. Oracle's taken on a huge amount of debt. Meta took on a huge amount of debt. And I mean, first of all, these companies have billions and millions of dollars on their balance sheet, so they must be either exchanging equity financing for debt to lower their compound, uh, their weighted average uh, capital cost of capital, or they have huge investment plans for the future. Do you have any opinion on? I mean, is this a healthy thing for the economy that they're taking on all this debt? Is it unhealthy? Does it matter?
I think that as a blanket statement, I'm not a fan of taking on debt in an
Yeah,
environment where you don't have to do that, right?
yeah,
It's not prudent financial behavior. However, I do think that these companies are convinced that the first mover advantage, the ones that figure out the application of AI and really make it transferable to businesses where they can see massive productivity and efficiency gains across the economy, not just concentrated in the tech space. They believe in that idea wholeheartedly and are willing to borrow money in order to continue to invest in that. Now, I think that the real answer to your question is it depends on who the winners and the losers will be. Because in hindsight, the companies that win this race will look smart for borrowing that money to invest. The companies that are on the losing side of it are going to look abysmal and probably will be pushed out of the market completely. And so, as always, it's more of a question of, who do you believe is going to be the first race or even the second race winner, and rather who is going to be the ones on the losing side. The losers are going to look very foolish for taking on all this debt. The winners will look very smart for doing so. So it's
got it.
not a blanket answer in that regard.
Got it. Okay. And so we have an audience question, and please, if anyone else has one, please jump in. My friend Mike wants to know, tangential to the NVIDIA AI question, do you see an impact on the economy around all the data centers, power grids, water usage, et cetera?
Yeah, the most tangible impact will be rising prices. I mean, and that is the consistent thing that does not change regardless of what happens and who the winners and the losers are. The more data centers compete for electricity, with residential neighborhoods and with hospitals and stuff, the only lever to pull there is to increase the price because there's not enough supply for an infinitely growing level of demand. So yes, I do think that there's going to be implication. It's not limited to energy. It's going to be affecting water, although I think that the fears of water shortages driven by data centers are overblown. There's a lot of liquid cooling technology that's coming in line that doesn't use water. So I think that that's a bit a bit kind of over its skis in terms of the fear factor. But consistently, what I see is that is another force adding to the inflationary argument that prices are likely to continue going up at a slightly accelerating pace relative to what the Fed wants them to do, which is decelerate and stick around the 2%. I just don't see a 2% inflationary environment in our foreseeable future as a result.
Yeah, I read that, or I guess I heard on a podcast that China's electricity is about a third the cost of it of electricity in the U.S., and that could provide them an AI advantage because it's cheaper for their AI
Yeah, I mean
companies.
the hydropower equation, and
Yeah,
this is true not just for China. Obviously, Brazil gets a lot of its power from hydro. Canada is a great example, our friendly, non-threatening neighbor that I talked about. And I think that one of the issues on the table, by the way, in President Trump's negotiation with Mark Carney is access to the Canadian grid and to be able to pull some of that cheaper power, not just for data centers. But for example, if you look at aluminum smelting, right? Super energy intensive industry. We don't do that here because it's much cheaper for the Canadians to do it because of all the hydropower that they have.
yeah.
So there are some talks about integration of the Canadian grid with the US grid to pull on some of that energy that they're generating that's much cheaper. But to answer your question more directly, yeah, it's a big competitive advantage for China. The other one, of course, being that they are much less concerned with profitability and more concerned with being first in any of these competing sectors, right? So
Right.
that I think would be a much bigger competitive advantage compared to the U.S. than the electricity side of things.
Interesting. Okay. Wow. Well, this is absolutely fascinating. Thank you so much. I do want to share a couple of upcoming programs if people can hang on for just a second. We have AI News and Gurus with a special guest from Google. Patricia Velasquez is the education strategy and insights lead. She's going to be going in depth about some recent B2B buyer research that Google did. It's really an honor to have her on the program walking through this fascinating research. I mean, if you sell in the B2B market like every distributor does, you really should dial in and listen to co-host Brian Hopkins, who's our COO, and Brooks Hamilton, who's with AI Strategy Advisors. That's on December 2nd at noon Eastern, 9 a.m. Pacific. And then on December 3rd, we have breakthroughs in warehouse and logistics technology. There's a whole bunch going on here that is fascinating and important to distributors. We'll have Mike Herter, who's the VP of Supply Chain for Infor, and Chase Eldridge, who's the VP of Sales for Powerfleet, talking about some of these breakthroughs that are really helpful to and important to distributors. So hope you'll join us for those shows. That's December 3rd at noon Eastern, 9 Pacific. But for now, Alex, thanks so much for such a fascinating presentation. I learned a lot. I know our audience did as well. It's always just a pleasure and honor to have you on our show, and we look forward to the next time.
Thank you so much for having me in. Always a blast. Take
All
care.
right. All right. Thanks, everyone. Take care. We'll see you on the next Distribution Strategy Group program. Bye now.
Bye-bye.